If you're short this market right now, it's going to get real painful probably for the next couple of weeks.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back for another weekly market recap, featuring, as always, my good friend Lance Roberts. Hey, Lance, how you doing?
Good. It's Friday. It feels like it's been a month already. It's just been a week.
Yeah, and actually, it's been slightly less than a week, folks. We're recording this on Thursday, for two reasons. One, I have to be on the road tomorrow, and secondly, Lance is having to move out of his house. As he's been telling you folks, he sold his house. Well, now's the time where he actually has to get out, and he's going through all the fun.
Yeah, now I remember why I hate moving. So I swear, every time I move, I swear I'll never move again. And now I remember why. So,
yeah, folks, if you were inspired by Lance's decision to sell his house in advance of the
don't do it.
in the housing market,
don't even do it. Just stay where you are.
Yeah, are you doing the mental math? Like, what kind of housing market correction would I absorb percentage-wise to not have to move? Right?
Exactly. It's getting a lot larger. Every time I have to move a box, that downside is getting larger.
You're like, all right, I'm now in the double digits. I could take an 11%.
Yeah, exactly.
God, if I got to move that now, I'll take 15. All right. Well, look, good luck in the process, buddy. I know it's zero fun.
Yeah, it is.
All right. Well, look, even though we're doing this on Thursday, it's already been a pretty eventful week in the markets. Why don't we talk about the market action so far this week and then what's driving it, which in large part probably is the announcement yesterday from the Federal Reserve and the most recent statements by Chairman Powell. So take it from here.
Well, yeah, and look, there's really not a whole lot to it. And first, let's just start out that we have probably seen a bottom for the markets. We've probably not seen the bottom for the market yet. And the reason I say that is because, look, we've talked about on the show, numerous times, is that, we have a massive amount of negative consumer sentiment towards stocks. 12-month return on stocks is at historic lows. We've got the Association of Investors, which shows record, negative sentiment on stocks. Net long positions and for portfolio managers and hedge funds are near some of the lowest levels on record. So you just have, all this bearishness has been built up in the markets, and as I've talked about, is that's actually a contrarian signal that tends to be a little bit bullish in the short term. And what we really need is we're going to have another leg of the bear market, which is very likely, and I'll explain why in a minute, is that because we have all this bearish sentiment, so you've got to get that bearish sentiment out so the bear market can actually continue. And it seems kind of weird, but it's hard to have a bear market when everybody's bearish. And so we need to get Jim Cramer pounding the table on CNBC, declaring the bear market, the bear market's over and the bulls are in. And that'll help relieve some of this downside pressure, get people back kind of on the long side of equities, get some of this kind of oversold condition, wrung out of the markets. And then you can start to have the realization come in that, things aren't as great as they go. But look, I mean, we talked about, last week on this show, that one of the things that we're looking for to buy equities into our portfolios, we're looking specifically for companies that report and miss earnings, but then their stock price goes up. And we saw that twice this week with both Microsoft and Google. We've added to those positions this week simply because of that. And you're starting to see that a lot of these stocks have now started to discount a lot of the bad news. Meta is another one of those. Stock reported atrocious earnings. The stock was barely down. And last quarter when they missed estimates, stock was down 25%. So, a lot of that negativity has already been priced into a lot of companies. And so we're starting to see some of that potential basing here short term. Now, that doesn't mean that we're through the bad news, right? And so this is the important part. We haven't got into the recession yet. And once we start getting into the recession part, now we'll see a recession in earnings. Now we're going to have to lower valuations again in order to accommodate for lower earnings. So that's what I'm saying is like we may see a short intermediate term bottom that could last a couple of months before we get into the next leg of this cycle, which is going to be the earnings recession, which is still likely to come, particularly with the Fed still hiking rates.
All right, great answer. I want to get into some of the specific comments the Fed made in just a second, but if you think that there's potential here for the bottom to be in, at least for the next couple of weeks, couple of months, let's just assume for a second, reading the tea leaves as you see them, understanding that I'm asking you to speculate here, what do you see as more likely? A kind of the market taking a green light that this is time to go higher, and we have a pretty substantial rally even from here, because prices have come up a bit over the past 2 weeks. Or do you see it more as just sort of a flat lining over the next, until the next shoe hits?
Well, look, right now the pain trade is higher. That's the bottom line. Again, when you start talking about all this kind of negative equity positioning that we've got going on here, you know, it's not going to take a lot to start dragging these portfolio managers back into the markets. And the reason is really twofold. Remember, we had FOMO in 2020, 2021, right? Because everybody had the fear of missing out on the rally. Well, now you've got, you know, kind of the same FOMO, but it's the fear of missing the bottom. And for a portfolio manager, and look, I fall into this camp, right? So don't get me wrong, what I'm saying, I'm not bashing anybody because I'm right there with them, is that, you know, we have a pretty substantial lead over our benchmark right now because we've been underweight equities this year. But if we sit around here and keep holding our 40% cash that we have in our portfolio, if this market rallies, we're going to give up a big chunk of that lead that we've got over our benchmark. And, you know, that's what we call career risk. Because at the end of the year, if the market catches up to us and surpasses us, then all of a sudden it's like, well, what were you doing with my money? Because the market, you know, nobody looks at what happened intra year. It was, you know, what did the market do last year? Market was up 5% last year. My portfolio was up 1%. Why did you underperform? Nobody knows that middle part where we outperformed the benchmark by 700 basis points. Nobody remembers that part, right? It's just how you end the, it's not what you did in the middle of the race. It's how you end the race, right? Yep. And you know, this is problematic for portfolio managers and for investors in general. And you know, so there's going to be this push by the markets that every time the market rises a bit, it's going to drag more of these portfolio managers back into the market, which is going to drive the market higher, which is going to drag more portfolio managers in. That's why I'm saying the pain trade right now is not lower, it's higher.
All right. So it sounds like you would say, if you're positioned short here, you should be watching things real closely because there's potential for this thing to go against you.
Oh yeah, absolutely. No, if you're short this market right now, it's going to get real painful probably for the next couple of weeks. And again, it's just, again, I want to be really clear. We're not talking about, you know, the bottoms end of the market and we're starting off on a new bull market. I'm not saying that at all. I'm saying we've got a rally here to probably 4150, 4160. Somewhere in that range for the S&P 500. You're going to run into those previous tops that we were putting in back in I think in May or late April or early May. And, you know, before we broke down, you know, to some of these recent lows. So you've got a bunch of resistance that's coming up, but technically, right, the market's doing a lot of very good things right now, very bullish actions. We were in this very defined downtrend channel since the beginning of March. We've talked about that numerous times on the show, right? Last week, we broke out of that trend channel. We broke above the 50-day moving average, and we said that what we need here to really kind of confirm this breakout is for the market to come back down, retest that 50-day moving average, and then bounce back up above the recent highs. And that's exactly what happened this week. Markets had sold off Monday and Tuesday, came right down to the 50, closed on the 50-day moving average on Tuesday. On Wednesday, the market opens up a little bit, you know, waiting for the Fed announcement. And then when the Fed says their magic words of, we're going to be data dependent on interest rate hikes, the market shot off. The NASDAQ went up 4% on Wednesday, and we cleared those that high from last week, right? So we had this, it was a textbook retest of the 50-day moving average and confirm this bullish trend. And if you look at the market over the last several weeks, we've been establishing a trend of higher lows in the markets, a breakout of that trend channel, a break above the 50-day, a successful retest of the 50-day. I mean, you know, I don't care how bearish you are. That's textbook bullish action in the market. And you've got to trade with that for right now. And again, it'll be a fairly short-lived event, I suspect, but the trend is higher for the moment.
All right. So we're seeing sort of the classic bull rally textbook here. You got to respect it, whether you agree with it or not,
Exactly.
or whether you like it or not. But yeah.
No, whether you agree with it or not. I mean,
Yeah.
it is what it is.
It is what it is. All right. So let's now talk about what caused the pop this week. And you seem to think that it was the Fed basically saying, we've been giving you guys sort of exceptional forward guidance recently, where we kind of mapped out all the rate hikes that we were going to do over the rest of the year, et cetera. And now they're basically saying, we're going to keep our cards a little bit closer to our vest now, because we're getting to a point here where we're really going to look at the data in between meetings to really determine what we're going to do next. My presumption is that the market is taking that as like maybe the Fed is beginning to think it's not going to have to do all the rate hikes it told us to. And this is their little, indirect way of telling us that, or preparing us for that. Is that what you think, or do you have a different interpretation?
No, I think it's stupid, but I think you're absolutely right. Look, first of all, the Fed cannot continue to hike rates at 75 basis points every meeting. Okay, so logic tells you that at some point the Fed's going to have to stop raising rates, or at least slow the pace down, right? I mean, it's just, whether it's next meeting or the meeting after, just logic tells you that eventually you're going to have to slow rates down. So for the market to go, oh, well, maybe this cryptic message of, we're going to become data dependent, maybe that means they'll slow the rate hikes down. That's a stupid analogy, but it is a stupid analysis by the market, but that is what it is. And what's more important to this is that if you take a look at the Fed dot plot, right? One of the things that the financial media and et cetera has been pounding into people for the last 5 years in particular has been, don't fight the Fed. Whatever you do, don't fight the Fed. And if you take a look at the market, the Fed's dot plot versus what the market's projecting out on Fed rate hikes, the market's kicking and dragging their feet right now, fighting the Fed. So, they're doing exactly the thing they said that you shouldn't do, as they're trying to fight the Fed. But the Fed is going to have to slow rate hikes, no doubt about that. And they're going to have to pause at some point, or even pivot at some point. And here's the important thing, is that go back and take a look at history. Whenever the Fed has paused the rate hikes or have stopped hiking and started lowering rates, that immediately almost precedes a recession. And so two things to take away from what's going on in the markets right now. The first is that it is not uncommon at all for markets to rally when the Fed's hiking rates. It is not uncommon at all for the market to rally during the first 4 Fed rate hikes, which this was the 4th Fed rate hike today. So that's the markets have not performed exactly normally this year because of the Fed hiking rates, but it's not uncommon for markets to rally even while the Fed's hiking rates. And you're sitting there right now thinking in your head, well, that's just stupid because they're tightening monetary policy and, they're slowing the economy. Yeah, but it's taken markets a while to catch up to that. And right now, if you take a look at earnings, they're not great, but they're not as bad as everybody was expecting, right? Netflix is a good example here, right? They lost 1 million subscribers, but everybody expected them to lose 2, right? So clearly not as bad as expected. So let's rally the stock price. Google, same thing. Microsoft, same thing. This is something that, the markets are going to price in. But here's the thing to take away from this. When the Fed stops doing rate hikes, the reason that they stop hiking rates is because now they realize not that they have fixed the economy. They realize that they have gone too far and I can't hike rates. Exactly. Yeah. It's the realization, right, that you just waved the red towel in front of the bull and now the economy's coming for you. You either get, whenever the Fed pauses the rate hike program or starts reducing rates, is because they realize that they've now caused an economic problem. Now they won't admit it's their fault, but there is an economic problem that they can no longer hike rates, so they have to pause. So that's what I'm saying earlier, is that we may get this intermediate term rally, but the thing to take away from all this is that when the Fed pauses, it's not because the Fed's going to say, well, we're going to stop hiking rates here because the economy's booming and everything is great and unemployment is strong, yada, yada, yada. That's not going to be the story. The story is going to be, we're going to stop hiking rates here because, and this is what Powell said yesterday on Wednesday. He said, look, he said, right now we're seeing signs of economic weakness. Now, employment's still strong and inflation is high. So and look, the market, and not said is the financial market is giving us plenty of room to work because there's no financial stress in the markets. Credit spreads are not blowing out. The stock market's not completely cratering. So there is no financial stress. So right now I can go put my focus over here on inflation. I don't have to worry about financial instability. But when the Fed pauses, it's going to be because there's financial instability of some sort. And that's what I'm saying is like that's where we're going to see the earnings recession. That's where we're going to see the next downturn in the markets and those type of things. And that's just the nature of the beast that we've seen every time in history. And I doubt this time will be different, but you never know.
Got it. All right. Great explanation. I'm going to put up a chart here that was on Zero Hedge the other day. It may have evolved since this, but it supports your point, Lance, that the expectations between the markets and the Fed in terms of how hawkish or dovish the Fed's going to be are very different right now. So in response to the FOMC announcement, rate cut expectations have soared. The market is now pricing in almost 5 rate cuts over the next year and a half. Right. So the Fed is still talking the tightening game, right?
Yeah.
The Fed is still saying, hey, look, we're serious folks. We're going to do what needs to be done here. The market's already saying, well, whatever, buddy. I'm already predicting you're going to cut at least 5 times over the next year and a half. So I want to get to some of the specific comments that Powell made, but do you have any sort of additional reaction to that right now? Because it really does seem, looking at this data, that it's a game of chicken right now between the markets and the Fed, where Powell is saying, I'm very serious, and the markets are saying like, we don't believe you.
Yeah. No, I absolutely agree with that. And that's kind of what I was saying earlier is that, the market has been telling us forever not to fight the Fed. And now the market's actually trying to fight the Fed all the way through here. And look, maybe they're right. Maybe what the market is suggesting is that the Fed's going to have to start lowering rates sooner rather than later. But again, that's not a good thing. The market shouldn't be rallying on that. And this is one of the interesting conundrums that we have going on in the markets right now, which is that, it's illogical. What we saw on Wednesday was a good example of this. The market, rallied sharply on Wednesday after the Fed, talked about hiking rates, tightening monetary policy. They're going to keep doing this until the cows come home or inflation comes down. Then on Thursday, we get the GDP report. We have a negative print on GDP, 2 consecutive quarters. Now, I know the White House has now redefined recession, so that's not a recession, but we have had 2 negative quarters of GDP growth. And the bond market rallied, right? So now you've got inflation. You've got negative GDP growth, and bonds rallied, fairly sharply on Thursday. Then you've got stocks going off to the moon in spite of the fact that you have negative GDP and inflation. So neither one of these asset classes are responding to what the market environment is. So what are they responding to? Now, what they're responding to is simply saying stocks are going up because the Fed's got to pivot here. And that means maybe they're closer, it's a hope trade, right? Maybe the Fed's closer to going back to 0 rates and doing QE. The bond market's going, hey man, if we've got recession coming, that's going to push everything out on the long end of the curve for safety. The short end yields are going to collapse because the Fed's going to go back to 0 interest rates. And so, so bond yields are going to come down and bond prices are going up. So, everybody's playing the same game in the same way, and that shouldn't be happening. If inflation is going up sharply, and when we're going to continue to have higher rates of inflation over the course of this year, which is very likely. Look, inflation has either likely peaked or about to peak over the next couple of months. But inflation's not going to go right back to 2%. It's going to be a very gradual decline in inflation until we get into next year. And the reason is that the month over month rate of changes going back to this time last year, you're going to be stripping out, 30 basis points, 40 basis points, 30 basis points of inflation relative to the inflation print that's coming in. So inflation is going to remain high. Now, once we get into January of next year, that's where we're going to be matching up against 60 basis points, 80 basis points, 1.2% inflation for a month. Then you have these much bigger numbers. So inflation will fall much sharper in 2023. But that's going to be a while out there, right? And the market's pricing all that to happen this year, not next year. So, the market's got a very illogical stance going on right now relative to what the data is saying. But the whole play here psychologically for the market is I don't want to miss the bottom. I've got to get long stocks so I can get performance in, and I don't want to miss it when the Fed does pivot.
Yeah.
And that has nothing logically to do with the fundamentals of the market.
It doesn't. I'm going to just do a mini rant here just for a quick second. We've talked about this in the past, but this is what I think is one of or maybe the biggest issue that regular investors like the folks watching this program have to contend with, which is the market really isn't made up of investors anymore. Investors are people that look at the macroeconomic data and they look at the companies that are best positioned to capitalize off of where things are headed, right? And they try to pick the best winners going forward. What we are instead is we're speculators, where the market is just basically trying to figure out what a small number, less than 10 people around a table in the Eccles building, are going to decide. Right. And that's what's driving the action, clearly, as you just described here. Right. So it's super frustrating that, if you're trying to intelligently navigate your capital through this market, in some ways, you can kind of do all the old gumshoe detective work, classic Benjamin Graham stock analysis. But at least what's driving the action right now is just what the majority of the market thinks Powell and his crew are going to decide to do in the next month.
I know. And to your point, it's just absolutely crazy. I mean, but unfortunately, this is now it's my turn to rant for a second.
Go for it.
Because this is the crazy part. When the Federal Reserve has completely destroyed the markets, right? I mean, we were having this conversation just yesterday at our portfolio management meeting, is that Mike does a great job on every Friday. We publish a list at simplevisor.com of what we call our 5 for Friday. And we screen for stocks in various manners, and we come up with 5 kind of interesting stocks based on certain screens, right? And recently he did a fundamental value screen and came up with some really great companies that are fundamentally very cheap. Here's the problem. It doesn't matter. These companies are fundamentally cheap, but they're not going to go up when the rest of the market goes up, because what the Fed has done has created this environment where nobody really cares about fundamentals, and they're forcing more money now into ETFs than into active management. So now the money flows into ETFs are just dwarfing everything else. So you don't have to be a fundamental analyst anymore to outperform the market. So if you want to run I'm going to tell you what your portfolio needs to be, right? You want to run an all cap portfolio. Awesome. All you have to do is buy you need 30 stocks. The top 10 stocks in the S&P small cap ETF, the top 10 stocks in the S&P mid cap ETF, and the top 10 stocks in the S&P 500 ETF. You buy those 30 stocks, you're going to benchmark an all cap portfolio, because when all the money flows come in from all these ETF passive investors, putting money in the ETFs, all that money has to go into those stocks. And of course, those stocks in the top 10 capture most of the flows. So they're going to go up the most. So you may have the greatest fundamental value company on the planet. Market's going to go up 20%, and your stock's going to sit there and do nothing because there's no money going into it. And that's the frustrating part about investing, because we've completely destroyed price discovery, fundamental value, and what really drives, portfolios and returns, or should drive portfolios and returns over time.
All right, well ranted. 2 quick addendums to what you said. One, you mentioned Mike. You're talking about Michael Leibowitz, who's your portfolio manager there, right? A great guy. And folks, if you didn't see the interview that we did with Michael a week ago, I'll put up a link to it right here. It's a wonderful interview. If you want to get to know the team that works with Lance, that's a great way to start doing it.
Yeah, I taught him everything he knows, by the way.
Nice. I love how humble you are.
No, we have an ongoing feud going on right now. There was a book that was put out by David Stockman. And he now does a lot of macro analysis, but he was the youngest cabinet member of the 20th century. Actually, he was he ran the office, the budget office for Reagan back in the 80s. But he wrote a book. I'll see if I can put the title up here, but it's called The Great Deformation. And I think he really nailed it with that title. And he was mostly talking about what the Fed has done, but also other influences in the market, like you're talking about, passive investing with massive ETFs and whatnot.
where
and that's a great book to read, by the way.
it is a great book. I mean, it takes you a while to plow through. It's a big, thick book, but very well written. But I think that term deformation really does nail the character of today's market, where things have just been pulled kind of taffy-like out of any semblance of their true shape, that it's really hard for investors to successfully engage with it in any kind of intelligent way, because it's just so distorted and deformed at this point. Yeah. But anyways, all right, well, let's move on to the Fed. So in Powell's remarks the other day, he did, as you said, Lance, he said spending and production have softened. I think that was about as close as he was going to say to the fact that the economy isn't perfect. He did spend a lot of time saying, I don't think we're going to go into recession, though, folks. He did mention the R word, but saying that I don't think we're going to go there.
No,
and
not exactly. He said we're not in a recession right now.
He said we're not in a recession right now, and I'm trying to find the notes I had, but it was basically, he said, we're not going to go into a recession with a strong labor market like this. Right, which you and I have railed in past videos on, which is like, that is such a lagging indicator to look at, dude. But he's waving it like this magic talisman that, like, you don't have to worry about inflation because the employment market's strong. And I just want to put up this tweet here by Jim Bianco, who just noted that this was the exact argument that Arthur Burns, who was the chair of the Fed back in the 70s, made 50 years ago. So we already know that this argument doesn't hold water, but whatever, they're dragging it out of the mothballs and they're trying to use it now, just hoping that people don't have 50-year memories here, right? So, it's just additional, I think, firepower that the guys that are running this ship, the playbook, or at least the one that they're making available for public view, doesn't inspire confidence.
Well, look, two things. There's actually 3 or 4 things in there that we need to touch on from the speech. One is look, let's not forget that midterm elections are coming up, and the administration has already been leaning on Jerome Powell pretty sharply, blaming him for high gas prices and all the other problems in the economy. It's all his fault. We've got inflation. When in fact, the inflation came from all the government policy. We've talked about that before. So, a bit of the rhetoric is going to, while we try to say the Fed's independent and they're not politically motivated, they have a political bias. And look, and it doesn't matter who their boss is, but it's their boss. If you remember when Powell was under Trump and the Fed said, hey, we're nowhere near a neutral rate in 2018, and the market goes down 20%. And President Trump is going, we need to fire that guy. He's an idiot, blah, blah, blah. And then all of a sudden the Fed goes, well, guess what? We're really close to the neutral rate. So, here we go again, zero interest rates and, QE. And so, this is going to be the problem here is that now the Democrats are facing a really tough midterm coming up. Inflation, slow economic growth, all that stuff is not great for getting reelected. I mean, the political,
You're kidding me? It's kryptonite. I mean, it's the worst ever. But yes,
it's the worst thing. Forget your political policies; those are out the window. It's all about inflation. That's why you see such a big, push to talk about this fight of inflation. So, that's one thing, right? So what the Fed says isn't necessarily what's happening internally. The second thing, though, is I think that Jerome Powell made a mistake by picking on food prices. And he said that, he was watching food prices. Food prices are certainly elevated. That certainly impacts the consumer. The reason I say I think he made a mistake by starting to look at that. Now, normally they focus on PCE, and particularly they focus on the trimmed mean PCE. So that's the personal consumption expenditure inflation. And they look at that. And that's their inflation measure. It's really not CPI. All of a sudden, he started to drop in these little hints. Well, we're kind of watching energy. We're watching food prices, and that's all out of CPI. And, food prices are really high. Well, the problem with food prices and energy is they're sticky. Once food prices go up, they don't come down really sharply because, there's a point to where there's a elasticity in these prices, and people get used to paying a higher price for a certain product or good or service. And so once that price goes up, we may see inflation come down as a whole, and you may see the price of that food product or that service come down some. But since people are now accustomed to paying a higher price, they don't ever go back down to where they were. Back in the 1960s, we paid 50 cents for a gallon, quarter for a gallon of gas. We haven't seen that in never, right?
Right.
And you'll never go back to $1.25 a gallon that we had at the turn of the century, right? You're never going back there. Now that we've been at $5 a gallon, you may be lucky to ever see $2 a gallon again. And that's just a function that these prices are higher. Now, here's my point about this, is that if the Fed is focusing on these higher prices, that means that gives them another runway to potentially overshoot on hiking rates and inflation, because even though they may see inflation coming down, now they go, oh yeah, but food prices are still high, and they keep hiking rates, even though the rest of the economy is collapsing right around them.
Yeah. Well, very good point. And, we keep talking about the Fed making policy mistakes. We talked about, the likely danger here is the Fed is only going to pivot up at the point where it realizes that it's done more damage than it intended, right? And that's a great reason. We've used lots of good analogies, like it's like getting into an airplane and messing around with the instrumentation so that it reads incorrectly, right? You're just going to make bad decisions here, right?
Yeah. But so and one other thing though is talking about their meeting and kind of what they're doing policy wise is that again they're on this track to, and I think this is a mistake that a lot of investors are going to wind up making. And look, I could be wrong, right? And so this is why we have to kind of navigate markets for what they are. And any prediction that we're talking about today could be completely wrong by next week. So just take everything that we say here with a grain of salt and realize it could all change next week. But the other problem is that investors seem to be forgetting that the Fed is tightening their balance sheet, which is the real drive. Zero interest rates are one thing, right? That helps the consumer. The other thing is that liquidity from the balance sheet is what's been fueling a lot of this drive in equities, and that's that liquidity support that comes in. Well, they're reducing that balance sheet, and they didn't say diddly about reducing their balance sheet yesterday. And that process is still running and heading up to, now they're not at $90 billion a month yet, but that comes up in August. But that's coming off. Now, let me clarify one thing, that when we talk about balance sheet reduction, I get a lot of emails from people going, well, if the Fed's going to be selling $90 billion a month, that means interest rates are going to go to the moon. That's balance sheet reduction is not selling bonds. Those are two different things. What the Fed is mostly doing is just allowing bonds to mature, and they're not replacing them on their balance sheet. They have a lot of short duration bonds that they've been buying recently. All the long duration bonds they bought back in 2009, 10, 11, 12, those are close to maturity. And so as those bonds come to maturity, they'll just allow them to roll off. So if my goal is, and let me give you an example. So let's say that come up August, they need to reduce their balance sheet by $90 billion. And I got some emails recently talking about this, like, well, I looked at the Fed's balance sheet and it actually went up by 10 billion, last month or whatever. They actually added 10 billion to the balance sheet. Well, no, what happened is let's say that in August, they need to mature $90 billion. And they've got $100 billion worth of bonds that all mature in August. Okay. They're going to have to go out and buy $10 billion worth of bonds and put them on their balance sheet. And you go, well, see, the Fed's still expanding their balance sheet. Well, no, they let 90 billion mature. They just had to buy 10 billion to cover the 10 billion that was also rolling off. So it's not the fact that the Fed, and the point is that just because the Fed is reducing their balance sheet doesn't mean they're out there just dumping bonds willy-nilly on the markets. And that's going to cause, there's going to be no buyer, right? And interest rates are going to have to shoot through the roof. That's not exactly what that means. Now, one other point real quick was about the consumer spending part. Visa just announced just recently, had really good earnings. And they said, we see no sign of recession. The consumer's doing great. Take a look at all the people charging money, right? Yeah. They're out there buying like crazy. Well, that's not exactly correct, because we already know that the average consumer is struggling to make ends meet. And this is the primer of this, which is, you hear from the media is like, well, the consumer is very strong. They've got all this cash sitting on the, in their bank accounts from all that stimulus that we sent them. They got like $2 trillion in cash sitting there ready to go. Well, if consumers have a bunch of cash, then why are they charging everything? Right. So the reality is the reason that Visa's got a great quarter going on, and I like Visa, by the way, the reason they've got a great quarter going on is because consumers have no cash in the bank and they're having to resort to credit cards to make ends meet because the cost of living has gone up. So they've got to charge it all their credit cards. So they're running their debt balances up. And we've talked about the fact we've got record credit card debt going on right now and everything else. So yeah, Visa's got a great quarter. Doesn't mean the consumer's strong. That is two different things. It just means the consumer's having to resort to debt in order to fund their cost of living, but that runs out. It's just a function of time.
Yeah, and we talked about this before. I went into this in some depth in the video I did recently about the accelerating weakness of the consumer. And if you haven't watched that, folks, we'll put up a link to it here too. But yeah, it's so funny for me to be watching that exact point play out in the media here, because it is being wielded as a positive when, folks that are just investing a little bit of extra, brain power into figuring out what's going on behind the scenes. It's just that the consumer hasn't downshifted their standard of living yet, right? So they got a bunch of juice, during the pandemic. They were spending that money and they're just keeping that spending going rather than tightening their belts yet. To your point, at some point it runs out. It either runs out because the consumers start applying some frugality to their lifestyle, or because they start maxing out their cards and the credit card companies start forcing that frugality on them, or they lose their jobs and that forces frugality on them real fast.
I was going to say frugality is never a function of choice. So
yeah, it rarely is. It rarely is. Although we've talked about, going back to the millionaire next door and whatnot, like that is the common denominator amongst self-made millionaires, right? Is embracing frugality, right?
But that was frugality of choice over a very long period of time. So what we're talking about doesn't affect those people, right?
Right. And we're also just making a commentary that I sadly share, which is just in general, that frugality is not a celebrated virtue in American culture.
Yeah, exactly.
All right. Well, look, a couple of things I wanted to react to what you said, but they're out of my mind, and I want to go into these next quick things. So you were talking a bit about recession and how the Federal Reserve is saying, hey, folks, I'm not worried about it. You shouldn't be. But then you have the Biden administration out there right now, and you sort of jokingly referred to this earlier, that they seem to be trying to change the definition of recession right now, and the media is kind of having a field day with it. At least the financially minded media is. And I got to say, I'm nonpartisan. I have equal criticism of both parties. But Biden did something I just don't understand the other day, where he said, I don't think we're going to have a recession. And I just thought, why would you put something like that out there, especially when there's a pretty good risk of it happening? There's very little gain and a lot of loss by sticking your neck out like that. Say something like, I believe in the resilience of the U.S. economy, or, whatever, put out some generic statement like that, but don't put out a statement like that that's going to make you look foolish if indeed more data comes in that disproves you. And of course, a couple of days after he said it, we get that second official quarter contraction, right? So we're in what has been referred to as a technical recession until maybe the past 48 hours. And now we're being told that that's not technically the definition of a technical recession here. But what's interesting is you look at the GDP print, like I mentioned, but if you just look at the data that keeps coming in day after day, here's just one data point. New vehicle retail sales have crashed 11% year over year, right? I mean, we are really beginning to see this demand destruction that you and I have been talking about, play out in front of our eyes here. It seems incredibly hard that we are not going to go into recession, or at least something that feels enough like it to a voter that it's going to be an issue when they vote in November. So it seems like the strategy of just trying to convince people that, hey, there's no recession here and everything is awesome, seems like a losing strategy to me. What do you think?
Well, no, I agree with you. And look, I am an equal opportunity criticizer of every politician. So yeah, it does, because they all make terrible decisions, and we've railed on them more than once. But look, two things it's that, you're correct. And what you're saying is that, why would you say we're not in a recession when there's a very high probability of that? And yeah, look, unemployment.
Or that we're not going to have one, right? That's like Yellen saying, I don't think we're going to have a financial crisis, in our lifetimes. It's like, why would you say that?
Look, yeah, exactly. Look, and this is like saying, I don't believe in God, right? And you can say, I don't believe in God, but what's the risk right, of believing in God. And here's what I mean by this is that, so if I believe in God, right, and I die and I've been good and I believe in God, I get to go to eternal peace, right? So I live in heaven and it's great, and it's wonderful, and there's angels everywhere. And my odds of dying if I don't believe in God and living my life in eternal damnation and burning in fire, I mean, what's the risk, right, of believing in God, just in case it's right? And it's kind of the same thing here, is that, taking on this dynamic of saying, there is absolutely no recession. Yes, we had 2 quarters of it of negative growth, but that's not really a recession. Recession has all these other factors to it that have now popped up out of nowhere. But to your point, the odds are that we're going to have a recession, and so you should at least quantify your statement, saying, look, I think maybe, possibly, we might get through this, this situation without getting into a recession, but there's a risk of one. And at least, put out that possibility, because this is all going to come back on him, and possibly at the worst time ever, which is going to be right in the middle of the midterms, that there's going to be a realization that we are in a recession, and everybody's going to look back and say, and this is going to be all over Twitter. And, the thing about the internet, it never goes away. This is going to be everywhere. There is no recession. I don't think one. So all these people that are making these non-recession claims really face that risk. It's much better to look, is there a possibility that we could avoid a recession? Absolutely. There is absolutely a possibility. I personally think it's a very small possibility, but I don't want to live life in eternal damnation. So I'm going to give it the benefit of the doubt so I can go to heaven, that there's a small possibility that we might avoid a recession. But I think the data is plenty, I think there's enough data out there now that suggests that the economy is slowing at a pace that will lead us into slower economic growth. And look, let's just, and this is the thing that we should all just remember. Why does the Fed hike interest rates, and why is the Fed tightening their balance sheet, right? The sole purpose is to lower the rate of inflation. Well, how do you lower the rate of inflation? You've got to kill consumption in the economy, because that's where the inflation comes from, is supply and demand. And so if that is the premise of the Fed, to sit there and say, and they're not done hiking rates yet, by the way. And by the way, all these rate hikes that they're doing, now, so the first rate hike was when, Adam? March, right?
Right.
Okay. What's 9 months from March?
When those policies maybe actually begin to get felt in the economy.
Exactly. And that's just the first quarter point hike. That won't even show up in the economy until January. And then you just had 150 basis point hikes over the last two meetings. That's not going to show up until March, April, May of next year. So to sit there and say today we're not in a recession when the Fed is hiking rates at a very aggressive pace, mind you, this is all going to show up in the economy in a lag effect, and not to mention monetary supply. If you take a look at M2, which is completely collapsed now, there's about a 9-month lag between M2, inflation, and economic growth. So everything is telling you that we're going to have much slower rates of economic growth over the next 3 to 6 to 9 months. And to say you're not going to be in a recession, man, that you are taking the huge under on that bet.
So you've done a great job of giving all the details of why I'm so flummoxed by this, which is, why would you stick out your neck like this? Because it seems like there's so little to gain and so much to lose, and the probability of losing is so high that, to your point, honestly, the consumers don't care what you call it. They just care how they feel, right? And to your point, if things get as bad as we think they're going to continue to get over the next couple of months, it is highly likely people are going to be feeling like, hey, this is a recession. The guy running the ship who told us not to worry about either lied about it or didn't get the risk, and I got to go vote in a couple of weeks. Yep. I'm not happy about that guy. Like, why would you take that risk? I don't know.
Look, it's absolutely right. And again, this is probably going to hit again, at the worst possible time. A lot of this data is going to start sinking in October, September, October, and your election's in November. So, right there at your doorstep, you've already campaigned, you've already put out your notices, you've already spent all your money, and then you're going to start getting a big chunk of data sitting out there that is, undermining basically everything you said. Now, the only good thing that the Democrats have going for them is that inflation will likely come down. And, we've talked about this now, not a lot, but there's going to be those kind of this initial kind of stabilization and early decline of inflation. So they can at least point to that and say, see, we're bringing inflation down for you. It'll be no fun.
They might be able to do that. And look, anything's possible.
Most voters don't understand inflation, and they don't understand how it's calculated. But but I'm going to agree with you on this. They're still going to be paying a bunch of money on food prices and at the pump.
That's what it's going to say.
Rate of inflation coming down, but it ain't getting cheaper.
Exactly. They don't care if CPI goes from 9.1 to 7.6 or whatever. They just know they're still paying a lot at the store and they're angry about it, right? Yeah. And of course, if we start getting the big wild card here, as we kept talking about, is we start getting these increased layoffs that we think may be coming, then it's game over, right? Because nothing makes you as angry about the guy running the show if you just lost your job.
Yeah, well, no, and look, you're seeing that already. I mean, jobless claims are coming up. They haven't come up a lot here, but they are coming up. And, that's the early stages of it. And yes, employment's still strong, but that's like, as you said earlier, it's a huge lagging indicator. But layoffs are coming, terminations are coming, and that's just a function of time.
All right. Well, we're going to talk more about that as they begin to happen in future videos here, because that's something you and I track real closely. All right. I got a couple more bullet points I want to bang through before we finish up here. Key one is just trades. What trades have you guys made over the past week?
So again, we've been really underweight tech this year and more overweight value and the inflation side of the ledgers. So now what we're doing is starting to build out a little bit of our tech trade, our tech side, our growth side. So as the economy does begin to slow, growth should start to outperform here a bit better. And again, as we said, we were looking for companies that, were reporting earnings, but still being rewarded even for missing earnings. And we saw that with Google, we saw it with Microsoft this week. And so and again, we already own these positions. Now I want to be clear about this. We already own these positions. We had much bigger positions in them in the beginning of the year. We took profits in them, we reduced those position size markedly. So now we're just adding back into those positions. We sold entirely positions in NVIDIA and AMD and Amazon earlier this year. We've added back small positions in those. Again, what we're looking for here, of course, with the semiconductors, we're following the Nancy Pelosi trade. So, we're buying some semis for the semi bill. But no, we actually like these companies long term. We think they're in the right spot. Valuation's going down. A lot of that overpricing has been wrung out of these stocks. They're still not cheap fundamentally, but if we do start getting more of a growth trade within the markets, those stocks will perform better. So we've added little bitty kind of, we've talked about planting a garden before. All we've done is plant some seeds. So we bought some very small positions in these. They're just initial positions. And we've talked about position sizing before. And what we'll do with these is we got very clearly defined stops, a little bit larger stop losses this time because we want to give them time to mature. So we've planted the seeds, and if the stocks pull back, which we hope they will, then we'll add some more to them. And as they start to rally again, then we'll add into them. And as we kind of work our way through whatever the bottom is in the market, then we'll, work that position accordingly. Now, if we bought these positions and they run straight up to the moon and, get extremely overbought, extremely, stretched near term, we'll probably just sell them and take profits, lock into trades, let the market, come back down again at some point and then buy them back. So again, every position is always and ever a trading position when we first put it on. If it begins to work and stabilizes and begin to play out into a longer term measure, then it becomes a longer term trade. I mean, we have positions in our portfolio we've owned for years, but those are positions that we have regularly taken profits out of, added back to, and managed our cost basis and risk accordingly. Again, we never go to a zero equity position. We reduce those equities largely because we're looking for reduction in volatility. But stocks that we keep always pay a dividend. So we're continually picking up cash flow into the portfolio over time. So that helps lower our volatility, increase returns, and increase our total return, kind of over the long term. One thing we also like going on right now, we haven't added yet, but bonds are starting to look a whole lot better. And we've actually started to form a very interesting inverse head and shoulders in the 10-year treasury. And if we get a move up to about 119-ish, we're going to break out of that neckline of that inverse head and shoulders. And it's going to be game on for longer duration bonds.
All right, let me ask you about that one, because I was just about to. And as I recall, your longtime sort of your thesis for holding it as it was never a couple week trade. You were holding it for kind of months, right? And the general thought was, all right, at some point the Fed's going to pivot, and it's probably going to pivot because it broke something, and so it's going to be a bit of kind of a crisis trade, right? Like money flowing into to find safety in the long dated U.S. Treasuries. But now the market's kind of getting a little frisky, right? Like, oh, all right, we think the Fed's going to pivot, but not pivot for bad reasons. It's going to just be cutting, for the next year and a half or whatever. We're going to go back to kind of the world we were in before.
Right. So they think.
So the market thinks, yeah. So I guess, is that why TLT has been doing okay the past week or so? It didn't really react all that much to the announcement this week from the Fed. But I guess my question is if the market has this near term rally that might be measured in weeks or a couple months, do you expect TLT to participate in that, or would you expect it to cool and only come back to life again when people get fearful again?
It's hard to tell. And actually bonds have been rallying now for about 3-4 weeks. They've actually been rallying with the market. And we're kind of back to this correlated rally between stocks and bonds. Bond market's betting on disinflation, and they're looking at the Fed hiking rates, or looking at a reduction of the balance sheet. That is going to lead to a risk off rotation at some point and a disinflationary environment. Now, importantly also, we have 50%. So, we've talked about before about yield curves, and there was a lot of headline talk a few months ago. The 10-year and the 2-year yield curve is inverted, but that was the only one that was inverted. And we talked about back then is that it's not one yield curve that matters, it's a bunch of them. And we track 10 different yield curves. And what's important is that when 50% or more of those yield curves are inverted, that it's important. And right now we have 50% of those yield curves inverted. And if we get to 60 or 70% of those yield curves inverted, which we will as the Fed hikes rates, that is going to be your precursor for a recession. So this is just another thing going on. If you're over in this no recession camp, the yield curves are telling you there's a recession coming. But as we said before, it's not the inversion that is recessionary, it is the uninversion. So where we want to be long bonds is when we're in the middle of inverting. This is kind of like buying the bottom of a bear market, because once the yield curves begin to uninvert, they're going to uninvert very rapidly, because this will be where the Fed's now cutting rates on the short end. The short end of the yield curve is going to collapse. Even though the longer end is coming down, the short end is going to collapse rapidly. It's going to go back. The 1-year treasury, instead of yielding 3%, is going to go back to 0. The 10-year is going to go from 3% to 2%. So you're going to get this uninversion of the yield curve very quickly, and prices are going to spike on the 10-year bond. And of course, because of duration, you get a lot more bang for your buck, capital-wise, being long the longer duration bond. So, that's what's going to happen. And that's going to be the point that the economy is actually going into recession. Again, we won't have the official announcement. The National Bureau of Economic Research won't have come out and said, oh, we're in a recession. That'll be 3 or 4 months later down the road. But when that yield curve begins to uninvert very sharply, that's where you want to be long bonds. And we're just trying to get there sooner than later.
Okay. Thank you. So that's long U.S. bonds, U.S. Government bonds. The precious metals have responded pretty strongly to the Fed announcement. Just in the day here, we're talking gold's up 2%, silver's up over 7%, which I know a lot of long suffering or recently suffering precious metal holders are finally happy to see some green there, and 7% is a nice pop, although it's off a low number given where silver was a couple months back. Is that because you think the market is thinking the Fed is going to go back to easing sooner, and therefore it's not going to be getting inflation under control, and therefore it's sort of the inflation play coming back into the precious metals, or do you think it's for a different reason?
Well, first of all, what precious metals respond to is real yields, right? And interestingly enough, that whole correlation has been completely broken over the last 8 months. And,
I know, which is very frustrating for folks that got into them in advance.
Yeah. I mean,
predicting the event correctly, but not the
get the result, right? And this is the whole Bitcoin thing too, right? Bitcoin's supposed to be your hedge for inflation, and none of these work, right? I mean, you got raging inflation, and everything that was supposed to protect you from inflation didn't work at all. And this is just a part, and this was all because of all that liquidity that we juiced into the markets. It just created all kinds of distortions that we're now trying to unwind, and we haven't completed that process yet. But yes, precious metals should be doing it better in an environment where we start to see, and hopefully we'll see that correlation between real yields and precious metals come back into play. But yeah, hopefully you should start to see if we are going into recession. Again, there's two kind of big primary things that drive the gold trade, right? One is fear, and it's a fear trade. So when stocks are getting routed, money goes into gold, and it's gold and bonds. I mean, that's where money's going to go to. That's your fear trade. That's your risk off trade. So one thing we need to see is if markets really start to come apart, we should start to see that fear trade pick up. But if we are going into a recession, and I think this is again what the bond market's smoking out. This is what the precious metals may be starting to feel out a little bit early, is that the realization that a recession is coming. And those markets are starting to pick up on that. So I think you're seeing gold perform better and bonds perform better simply on this idea that we may, that the market's actually heading, or the economy's actually heading towards a recession, even though there's such a big denial of it.
All right, interesting. So as a capital manager, does that make them more attractive to you in the near term as something to start adding exposure to if you think these are finally sniffing out recession?
Well, technically they look like terrible, right?
Yeah,
I mean,
yeah.
we're long gold right now. We have a gold position in our portfolio. It's grossly underperforming.
Yeah, and you did trim it down not that long ago, as you
explained.
Yeah,
we did, and because it broke support, and it's gotten above support here. The reason we didn't sell the whole thing is that we broke support. We took a little bit of the risk trade off because it's just not working. It's rallied back here a bit. I would love to see, pull back a bit, hold that technical support, turn up, and start to perform better. And look, gold has no fundamentals. And I'm going to tick off a bunch of gold bugs, but look, there's no fundamentals to gold. It doesn't have any earnings, no revenues, no nothing, right? It's a chunk of metal, and it doesn't pay a dividend. And so this type of thing. So the only way that you can really trade gold is you have to trade it technically. And that's what we do. That's just the way we look at it. It's a commodity, and all commodities trade technically. So we trade it technically. So again, we like gold for its kind of fear trade hedge for portfolios. And I'd certainly love to see that thing heal up a bit, start performing better, and then we'll build into the position. But again, it just technically continues to look terrible right now. Just it needs to do, it's got to have some work first before we get into a better position.
Okay. So you're going to hold for right now,
Yeah.
but watch and then reassess.
Yeah.
Okay. All right. All right. Well, we're gonna have to start wrapping things up here, which may break the hearts of those that are used to you and I going for like an hour and a half or longer on here. But you got to go finish moving, and I got to go get ready for my trip. Real quick, as we sort of begin to wrap up here, I have not had a chance to look into this, just how busy it's been. You might be in the same camp, but maybe not. There's the whole reconciliation bill that it looks like the Democrats have gotten Manchin to agree on the terms for, I'm ignorant at this point of the specifics of it, but reading the headlines, it sort of sounded good, right? It sort of sounded like reforms that would bring down inflation, and it didn't seem like a crazy tax and spend. We're going to add gasoline on the fire like some of the earlier bills that were being considered for fiscal stimulus. Maybe that's just the lipstick on the pig I'm seeing here, right? So what's your reaction? Do you have any hope for this, or is this just more
No, I think there's, in terms of hope getting it passed, I think there's probably a reason that they needed Joe Manchin on board to get something passed, right?
But I mean, hope that this will actually help.
It's not going to help.
Okay.
Look, it's 400 billion. Okay, so let's just do some math. Okay, for a second. First of all, let's just take this for what it is. So first of all, what this is called the Inflation Reduction Act, right? It ain't going to reduce inflation.
Okay. Yeah, okay. And sorry to interrupt, but this is it's like the adage that everything that the bill says, it does the opposite, right? Affordable Healthcare Act does the opposite.
Right, but here's the thing, though, right? It's actually a genius marketing ploy by the Democrats because look, you and I know that inflation is going to come down. Right. It's a function of supply and demand of the economy. You get into a recession, you're going to have a big chunk of disinflation, deflation. This bill is so small that it's not, and I'll explain to you, it's like $400 billion. That's small. No, okay, hold on a second. I'll explain why. It's so small that it's not going to actually create any economic issue. And so inflation is going to come down. They're going to say, see, we spent
$400 billion. They're going to totally claim credit for it.
Yeah. And inflation came down, just like we named it the Inflation. We named it the Inflation Reduction Act, and inflation came down. So if
it's like the Autumn is Coming Act. Right.
Exactly. And so if that 400 billion lowered inflation, just think what it would do if you allowed us to pass $3 trillion, right?
Yeah.
Now this is the whole point. So, what this is Build Back Better. And instead of shoving it, well, no, instead of shoving $3 trillion down your throat, they're going to feed it to you 400 billion at a time, right? So one spoonful at a time, you're still going to, they always say, how do you eat an elephant? One bite at a time.
Right.
That's this, right? That's exactly where we are. So yeah. So look, real quick run through. It's 400 billion over 10 years. Do the math. That's 40 billion a year in a $20 trillion economy. That's basically a water dropper, right? I mean, and it's so spread out. That's 40 billion spent over a year, which is very little impact on the overall gross economy. And it's going into areas that really will have a negligible impact on economic growth. Look, we're slating a bunch of money for clean energy, building superchargers and that kind of stuff. And that's all great, except that, the whole green energy thing is actually very inflationary in and of itself. I was just talking, I had to have just a quick little side note. I had to have an electrician come to the rental house yesterday so I could install a new plug so that you and I can do our videos on Friday. So, nice. So in the office, I had to have an extra plug installed. And so he's a master electrician, and he does a lot of work in kind of the richer areas of Houston. Right. And if you know the Heights in Houston, you know what I'm talking about, but it's where your upper income individuals live. These are not your, apartment renting group, right, in the Heights. And so he goes out to the house and the guy says, yeah, I need a plug installed for a supercharger for my car. And he says, I just bought a Tesla and I want to be able to plug it in. Well, that requires a 60 amp outlet at the house, which you've got to put that into your breaker box. Well, in order to do that, you've got to upgrade your breaker box. Mm-hmm. And the entire cost of doing that runs right around 10 grand. And then if you want to add a pool to your house on top of that, well, you're going to have to upgrade your whole system. And that's going to be another big chunk of money. So right off the bat, to upgrade your house to have a charger for your electric vehicle is going to start to run you north of $10,000 with labor and everything else. And then the cost of the car, and then the cost of the replacement. We've talked about before is that, you see a lot of these break-even runs on electric vehicles. They say, well, an electric vehicle will break even with an ICE vehicle at 90,000 miles. Well, that's based on a car that does 125 miles on a charge versus a 400-mile range of an ICE car. If you actually run that out to where you've got equal mileage on both cars, it takes about 300,000 miles to break even. So all of a sudden, then you've got to build in the cost of the replacement of the battery and all the other stuff. So this becomes very inflationary. But here's the point: the only people that can afford an electric vehicle are the people with the liquidity, right? It's like the top 10% of the people own 90% of the stock market. The only people buying electric vehicles are the ones that can afford them at the upper end of the income scale. And so this is by nature, and this is the point about all this, it costs a lot of money. And to build out, additional, solar and wind and all this, it's sending a lot of money into areas of the economy. It's going to boost the cost of commodities, which is going to boost the cost of other goods and services. It's going to drive more demand for electricity. And again, as you start building out more and more of these electrical type vehicles, that's a bigger drag. And we've talked about the grid before. That's a bigger and bigger drag on what you're getting on the current electric grid, which can't supply or maintain the electricity that's needed anyway. So this just creates a whole lot of problems down the road that we're going to have to get to, which again, this all sounds great in nature. We're going to save the economy by making it green, but it's actually a very inflationary problem longer term that has got a whole bunch of other problems on the back end that we haven't even addressed yet. So, the bill sounds great on the surface, but it's not going to do a lot in terms of creating better economic prosperity for the average American, right? Because we're not sending checks to households. So a lot of this stuff you're not going to see. And unless you happen to be in the upper 10% of the economy that's driving a Tesla, yeah, you're going to get great. You'll have some chargers closer to your house to charge your car. But for the average American, that has no effect on them whatsoever.
Okay, yeah, but it doesn't sound like, what we were seeing last year, where it's putting a ton of money directly into the economy and really making the inflation problem worse, like we're dealing with right now.
No, it's going to create inflation, but it's not going to do much. And the reason is that it's really focused on three things: clean energy, expanding the Affordable Care Act, which is already hugely inflationary if you're on the Affordable Care Act. It ain't cheap. And then they're going to try to pass, prescription drug benefits of some sort, or prescription pricing of some sort, to try to lower the cost of prescription drugs. And again, this is, those things that when the government tries to impose something, it generally never works out that well, which, probably suggests we're going to wind up with higher healthcare costs because of trying to lower.
It's longer term repercussions will probably make it worse. So this is the COBRA problem.
Yeah, exactly right. So again, that's what I'm saying, is that it's more likely it's not going to help the economy, and it's going to probably wind up hurting those at the bottom 80% of the income scale.
Okay, yeah. Like, unfortunately, and again, no matter which administration's running the show, that tends to be the way the script plays out, unfortunately.
But inflation will come down as a measure. So the Inflation Reduction Act will be a great marketing scheme.
Yeah, no, I agree. I mean, I think, look, if you can get away with that right now, because as you and I have talked about, we think as long as it's measured by the CPI, at some point that number is going to start coming down. Every month that goes by, when it hasn't come down yet, we're just closer to that date. So if you can try to capture the public attention as, hey, the thing I did brought that down, you're going to get a lot of undeserved cred.
It's all about the vote. And I just have one last rant here, and then
I'm trying to finish short for your time. So rant.
Okay, well, no, I just have one last thing to say, is that we talked about this on our radio show this morning. Is this whole market has now become a just follow whatever Nancy Pelosi does market. Mm-hmm. And it's just now become just a bold-faced movement that Congress inside trades, and there's no repercussions for this whatsoever. Even the Fed got knocked for a couple of the Fed guys that were trading their portfolios ahead of Fed policy. At least they got a little bit of a ding out of it. They were all exonerated by the Fed Review Board, of course.
I was going to say, you heard the results of that came out, which is no wrongdoing.
No wrongdoing. But one guy quit, right? So, at least there was a little bit of, well, maybe this doesn't look so good for us. Maybe we shouldn't do it. But now it's like, yeah, we're going to pass a $50 billion bill. Let me inside trade. Just follow whatever Nancy Pelosi does. It's now become a meme. I mean, it's gotten so bad, it's become a meme. And again, if you and I, did this, we'd both be in jail. So
yeah, well,
it just frustrates me.
But more than a meme, there are services that track purchases that you can use it actually as a trading strategy, right? But no, that totally stinks to high heaven. And this is not an attack specifically on Nancy Pelosi. It's an attack on Congress for letting this happen. And it's a great example
she's just the most visible about it.
Yeah, and it's pretty egregious. I mean, her husband's trades, they're not small trades. They're $1 million trades. Oftentimes they've got big call option blocks, right? I mean, so if he's right, and if indeed he is placing them because he's getting nods, through his spouse, that's absolutely horrible. I mean, it's a lot like, people look at, this is a small example, but like, if you serve in Congress, You get a lifelong pension, you get lifelong health care. It's not the Affordable Health Care Act. It's a, gold-plated Cadillac style, right? And people just look at it and they say, that actually just doesn't feel very right. Like when the head of the Federal Reserve, finishes and then goes and works at Citadel, right? And it's like, wait a minute, these companies that you were regulating are now paying you these ridiculously fat lifelong salaries afterwards. You sure that wasn't influencing you while you were actually, designing policy?
Can't imagine. Look, it's like everybody that works for the SEC, right? The only reason people work for the SEC is so they go work for Goldman later, right? And or UBS or whoever. I mean, this is all a revolving door. Look, you can fix this problem really easy. Is that, look, if you work in a public office, right, you work for the government, you work for, a major Wall Street firm, whatever it is, you can only invest in treasuries.
Yeah.
And now once you leave, you can invest in whatever you want, but while you're in the job, you can only invest in treasuries. And if you work for a central agency like the Federal Reserve or the SEC, you have to wait 10 years before you go work for a Wall Street firm. Right. So you can just kill that revolving door. And now all of a sudden you take all that, there was an investigation, you may not remember, but there was an investigation into high-speed trading. And this is when Flash Boys first came out.
Mm-hmm.
Right. But there was an investigation into high-speed trading. And right in the middle of the investigation, the head of the SEC unit that was investigating the high-speed trading firm quit and went to work for the high-speed trading firm. And it's like, but it's like, how do you get the investigation off your back? And by the way, the investigation went away right after that. It's like, hey, instead of investigating me, why don't you just come work for me, right? I'll pay you a ridiculous sum of money. But if you lock out that window and you close that revolving door and says, look, if you want to work for the federal government, that's awesome. You work for the SEC, fantastic. We love you for doing a great government job. Keep the regulation going for us. That's awesome. 10 years after you quit, 5 years, right? Just put a number on there. 5 years after you quit, you can then go work for a Wall Street firm. But at least during that period while you're working for the SEC, you're not being influenced by, hey, come take this huge salary to let me off the hook for, basically ripping off average Americans.
Right. And I just did a debate on this channel, which I'll put up here. Very interesting debate done between Mike Green versus Yaron Brook, and it was, should central banking exist, right? And so you had a guy, Yaron he's chairman of the Ayn Rand Institute. So I mean, he's like a total super uber free market type guy, right? And in the comments to that, a lot of people championing free market versus tinkering with the free markets. But you and I think we even talked a bit about this. Like we don't here in the U.S. have a free market. Yes, we are probably more capitalist than most countries that are out there still, but it's not utopia here. That there are a lot of special interests that are driving a lot of the action here that are unfair, and we rant about those a lot in this case. Whether we want to talk about stock buybacks, whether we want to talk about the advantages that corporations have over individuals. I mean, we can go through a whole bunch of different things, the benefits that the people in the political system have. And we do this, folks, not to, just be cranky old guys. We do this to sort of hopefully give you a clearer sense of the playing field and how in many places it is not slanted to our advantage as individual investors. And we can't necessarily give you great solutions to every problem that are out there, but at least we can tell you where the predators are spending most of their time, so you can tread more carefully if you're going in those areas.
Yeah, no, that's right. Like I said, it's a rant, and so I'm done.
All right, good. All right, well, look, Lance, good luck with the move.
Yep.
Folks watching, a couple of things. So Lance, we've talked a lot about the retirement seminar that we are going to do for this viewing audience. I feel like we've been talking about it forever. Folks are probably losing faith in us. The ball is actually now in my court now that Lance is back from Europe to nail down the date with his team and to be able to give you a link to register. That was on my plate, just given the crazy things that have happened over the past 48 hours. I couldn't get it done before this recording. I do commit to having it for you guys next week. So we'll have the date. We'll do it. We'll do it at some point in August. And then I want to do a little pre-push here. So Wealthion's, we do 2 online conferences a year. We did one back in January, which was very timely given how this year changed completely from December heading into 2022. We're now doing our next one on September 24th. And given all of the uncertainty that's swirling out here that Lance and I have just been talking about for the past hour plus, we're going to have just a murderer's row of experts coming together for that day to help you understand what's most likely to happen as we head into 2023. So more details coming out about that soon, but I just want to get that stored in your brains to be aware that you're going to get the details from me coming up quite quickly. All right, and with that, folks, everything we talked about here just underscored the need to be getting good financial guidance through these markets that we're heading for. If you've got a good financial advisor, great, stick with them. They literally are worth their weight in gold here. And as I said, gold's appreciating again now, so that's a good thing. But if you don't have one, or if you want a second opinion from one that is very well steeped in the issues we talked about here, and quite honestly, folks, a lot of the regular sort of garden mill stockbrokers, the stuff we just spent the past hour talking about just doesn't even hit their radars. So if you want to talk to a financial advisor who does get all this stuff well, perhaps even Lance and his team, just go to wealthion.com and we'll help you set up a free consultation with them. Doesn't cost you anything. There's no commitment to work with them. They just do it as a public service. So if you're interested in that, go to that URL. And then if you continue liking these weekly market recaps that Lance and I do, you're excited to see what his new digs are going to be like when he's set up in there and recording there next week.
It's a very small house.
But do me a favor, support this channel by hitting the like button. And then while you're down there, if you haven't already, click on the subscribe button, as well as that little bell icon right next to it. Lance, buddy, thanks so much for joining me for another week. Good luck with the move. Everybody else, thanks so much for watching.